Let's talk about one of the most powerful numbers in all of finance. It's a single percentage that can greenlight or kill billion-dollar ideas. It's called the weighted average cost of capital, or WACC for short. So, how does a huge company decide to build a new factory or maybe launch a brand new app? They can't just go with their gut, right? They need a solid benchmark, a hurdle that any new project has to clear to prove it's actually worth the money. And that hurdle, that's WACC. All right, here's how we're going to break it all down. First, we'll look at the price of money itself. Then, we'll build the WACC formula together, piece by piece. We'll also talk about why what's happening now matters more than the past, how WACC sets the bar for success, and finally, we'll uncover the deeper story WACC tells us about business risk. Okay, so first things first. To do big things, you need big money. And here's the thing, money is never free. It always comes with a price tag, because investors need to be paid for taking a risk on you. A company basically gets its funding from two places. You've got your creditors, think banks or people who buy the company's bonds. They provide debt. And then you have the shareholders, the owners of the company, who provide equity. Now, both of these groups expect a return on their money. Creditors want interest on their loans. That's what we call the cost of debt. And shareholders? Well, they're taking on way more risk, so they expect an even higher return on their investment. That's the cost of equity. The company has to make enough money to keep both sides happy. So you've got these two different costs for two different groups. How in the world do you blend them into one single number for the entire company? Well, that's where the formula comes in. Let's make this super simple. Imagine a project costs $300. The creditors chip in $100 and they want a 9% return. The shareholders put in the other $200, and because their investment is riskier, they want a 12% return. So, what's the minimum amount of cash that project needs to kick off just to pay everyone back? Well, let's do the math. You owe the creditors 9% of their $100, so that's $9. And you owe the shareholders 12% of their $200, which is $24. Add those together, and you need to make at least $33. Now, here's the key part. $33 on a $300 project is an 11% return. But wait a minute, a simple average of 9% and 12% is 10.5%. Why is our number higher? Because the shareholders, who want that higher return, put in more of the money. Their cost has more weight. And that is the whole idea behind a weighted average. And this brings us right to our basic WACC formula. See, it's just the cost of equity times its weight in the funding, plus the cost of debt times its weight. It's just a mathematical way of showing that blend we just talked about. Okay, that seems pretty straightforward, right? But the real world has one major complication we can't ignore: taxes. You see, there's this really interesting quirk in the tax code. The interest a company pays on its debt is tax deductible. This creates what's called a tax shield. It literally protects some of the company's profits from taxes, which actually makes debt a little bit cheaper than it looks on the surface. So we just need to make one tiny adjustment to our formula. We take that cost of debt and we factor in the tax savings. And there you have it. This is the complete, real-deal WACC formula that companies rely on to make huge financial decisions. Now, any formula is only as good as the numbers you plug into it. And for WACC, there's a golden rule you absolutely cannot forget. You have to look forward, not backward. This means we have to use market values, not book values. Think of it this way. Book value is ancient history. It's what an investor paid for their stock, maybe decades ago. Market value is what it's worth right now, and it's all about what investors expect to get in the future. So the bottom line is this: WACC is a tool to evaluate future projects. So it only makes sense that we have to use data that reflects future expectations. And the only place to get that is from the current market. Okay, so we've built this forward-looking WACC number. What's the point? What do we actually do with it? Well, its most important job is to be the ultimate benchmark for creating value. And to see if we're creating value, we use a cool concept called economic value added, or EVA. You know, EVA is what tells you if a company is actually getting richer or if it's just making enough to pay its bills. It separates real wealth creation from just looking good on paper. And the rule here is incredibly simple, but so powerful. A company only creates real value if the return it gets on its investments is higher than its WACC. That's it. You have to earn more than your money cost you. The project has to clear that hurdle. Let's go back to our little example. If that $300 project actually ends up generating a 20% return, well, that smashes our 11% WACC hurdle. The difference between what it earned and what it cost is how you calculate the economic value added. In this case, $27 of pure, newly created value. But, WACC is so much more than just a number you have to beat. If you look closer, it tells a really deep story about how risk works inside a business. Here's the final big idea. The WACC number itself actually represents the total, fundamental business risk of the entire company. And that risk doesn't just disappear, it's a constant. You can't change it just by shuffling your financing around. Here's a great way to think about it. Imagine a person's total weight. That weight doesn't change, right? But you can shift it from your left leg to your right leg. The WACC is the total weight, the total business risk. The costs of debt and equity are the two legs. If you shift risk away from the debt holders to make their investment safer, that risk has to go somewhere. It gets shifted right onto the shareholders, who will then demand a higher return. The total risk, the total weight, always stays the same. So in the end, WACC is that minimum return, that bar that a company has to clear to keep everyone happy and the money flowing. It's the ultimate gatekeeper for innovation. And that just leaves you with one last question to chew on. How many incredible, world-changing projects never even saw the light of day, all because they couldn't clear this one single number?